Bonjour, IPEM friends. We've gone through a few crises. We started in 1998, actually, in the midst of not just one crisis, but three crises. We had the Russia crisis, we had the Asia crisis, and we had the LTCM hedge fund blow up pretty much all at once in the summer of 1998. And that's actually when we started and started making our first investments. So I'd like to say we have some experience going through crisis. We all felt pretty good. Everything was quite positive. Returns were good. The economy was doing well. Unemployment was very low. Things were really as good as it gets. When it feels good, it's bad. When it feels bad, it's good. So, it felt pretty good. Everybody was in a good spirit. We're pretty happy. And when it's this way, you always have to think about, what could derail that mood, what could derail that environment, because things don't keep going on a straight line. If we look at 2020, we really have to look at 4 different phases. We had the January to, I would say, mid-February, which was continuation of 2019. Watching what was happening in China, but nobody thought it would get to where it got. And I think by the end of February and March, that's really when the pandemic hit the European continent and the US, and clearly then the markets reacted very negatively. You recall the cover of The Economist, they had a picture of planet Earth with a sign closed. That was pretty much where we were in March, April, May, I would say. Everything was put on hold. And then you had the massive and very quick fiscal and monetary stimulus around the world from governments. Reaction that was much faster than what we had seen during the GFC. And you saw right away the impact it had on the market. So at the end of March, already markets were starting to recover, and that continued in the spring, while the economic damage was really there. If you think about the GFC, all businesses were affected, maybe with revenues declining 5, 10, 20%, or 30% in some cases. But what we saw here during the pandemic is some industries where essentially revenues went down 80%, 90%, or in some cases, or even 100%. And you can't plan for that. I mean, that was a real shock. We entered summer with a lot of optimism. I think everybody was very much looking forward to having a little bit of summertime and start doing things that we were doing pre-COVID again. So that's I would say the third part of the dynamics in the market. And the markets continued climbing. I think a lot of investors and many of us were a little bit, surprised by the recovery in the capital markets, and that was confirmed in the fourth quarter. So the last 3 months, we've seen a significant recovery in investment activity, but also in exit and IPO activities. The best way to describe 2020 is call it a roller coaster. I mean, if we think back how we went through the emotions, the uncertainty, the fears, and there's still a lot of fear because, I mean, we're not out of the woods. China has come out much faster. The investment activity is very strong in China. The economy is doing well. We see it actually in our portfolios. And China has been in the best performing part of geographies for us. We're up over 30% in our Asian private equity programs this year. We're not out of the woods. So as positive as we end 2020, given how we started, one has to remain quite cautious and prudent. One of the things we're witnessing is really valuations. I mean, you see today some valuations, post-COVID valuations that are much higher than pre-COVID valuation for similar businesses. So a lot of tech-enabled software is more expensive today than it was a year ago. And valuations across the board have risen significantly. And you've seen the last few IPOs, whether it's Airbnb, we've just had that $87 billion market cap, or DoorDash, or Snowflake. I mean, those are extraordinary valuations. Be patient, be long-term, diversification. And I think a lot of these lessons have been learned by investors over the last few cycles. We didn't see, I mean, we've seen investors put programs on hold in the first half of 2020, but as I mentioned, we've had very successful fundraising year, and investors realize that it's very important to consistently deploy capital throughout vintages, through the ups and through the down cycles. And again, I mean, the cycles, and it seems like cycles tend to be shorter this time around. I mean, we had a very rapid drop and a quick recovery. And now we've gone beyond where we were at the beginning of the year in some segments of the market. And diversification, I mean, we've seen it in our portfolios. We've greatly benefited from a broad geographic diversification. We have big exposures to China, growth capital, and tech-enabled businesses, not just traditional industry buyouts, which is a big part of our portfolio, and that's doing okay. But that's not where we're getting the big returns in 2020. I mean, the big returns in 2020, you get them by having exposure to growth and tech and China. We've all been complaining, I guess it's been always viewed as a complaint that there's too much dry powder in private equity. But at times like we had in 2020, that's actually a big positive. The fact that there is capital in the private equity industry, and we've seen a lot of that capital go into portfolio companies to sustain, rather than take on additional leverage, and some did. And the last thing you want to do if you're a business and you're being challenged and you have difficulty is add leverage on top of that difficulty. We've seen equity also go into those businesses. So that's one of the things that distinguishes private equity, I would say, from capital markets, because equity capital is not there and debt financing is not there when things don't look good. But as a private equity manager, you have access to capital, and you can actually provide that capital to your portfolio companies when it's least accessible in the market. Private equity is in very good shape. I think the industry it did navigate the GFC very well, and it looks like it's navigating this crisis and this volatile environment quite well again. But we're not out of the woods. You still have a lot of people out of work in many sectors of the economy. Some will take quite a while to come back, and so I'm also hoping that the economic picture improves. We've seen a lot of innovations in private equity in the last few years. I expect that to continue, and that's just normal as the industry becomes larger and more participants, and I think the acceptance also of private equity being a less liquid asset class that's broadly recognized today, and so that's why the industry today is $5 trillion. And I have all the reasons to believe that we'll continue to grow. We see the attraction of private equity, especially if indeed private equity once again can show that it can navigate through crisis and produce superior returns, which at the moment we have all reasons to believe that it does that, and that will continue to attract more investors' interest in the asset class. A more sustainable recovery in 2021, and hopefully a broader recovery rather than what is often referred to as a decay recovery. You know, some industries going up and others going down. So that would be a good scenario. But you know, I think there are many scenarios for 2021, and we just have to see how it plays out. I asked my assistant to actually count how many Zoom and Teams sessions I've had every month since March. Just for the months of November, I had 147 of them. And I have to say that's extremely demanding. And I'd like that number to be down, and I'd like to have a little bit more physical meetings, a little bit more traveling, and a little bit more normalcy. I think everybody is looking for that, and I think we all would like to start doing things we were doing pre-COVID again. We all see each other virtually at the moment, and hopefully in 2021 we have the opportunity to all meet together in Cannes.